Welcome back to Reg Talk UK, the deep dive that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
This is the October 11th edition, and, well, if you have any exposure at all to motor finance, the information we're about to cover really does require immediate board-level escalation.
I'm Alex.
And I'm Jamie.
Today, our mission, really, is to chart the staggering scale of the FCA's proposed industry-wide compensation scheme for motor finance. I mean, this is the biggest redress scheme since PPI, isn't it?
Oh, absolutely. The scale is, well, staggering is the right word. We are looking at a potential maximum liability of 9.7 billion. That's assuming, of course, full consumer uptake.
9.7 billion. Wow.
And this scheme targets roughly 14.2 million agreements estimated as eligible for redress. That's out of, what, 32.5 million regulated motor finance agreements entered into since April 2007. So quite a chunk.
14.2 million agreements. That's
Yeah.
a fundamental reckoning for the whole sector. And critically, the window for action is closing really fast, isn't it?
It is. The FCA consultation period is running right now, and the deadline for feedback on the entire scheme, well, it closes on November 18th.
November 18th. Okay.
For many firms, this is probably the most immediate regulatory fire drill they've ever faced.
Right. Let's dive into the scheme itself then, because it really is dominating the UK regulatory landscape this month. The FCA was pretty blunt about it.
They were. They stated, and I quote, "Many motor finance lenders did not comply with the law or the rules." That legal clarity, it stems directly from landmark judgments like the Supreme Court's Johnson ruling and also the Clydesdale case in the High Court.
Okay, so the courts have spoken, and the regulatory consequences, this mechanism designed to fix the widespread failure to adequately disclose commission and contractual ties, which created an unfair relationship with the consumer.
Exactly. The scheme defines three primary arrangements, three triggers, really, that create this unfair relationship if the disclosure wasn't up to scratch.
Right. Can you walk us through those three key failure points?
Sure. Firstly, the one most people probably recognize, discretionary commission arrangements, or DCAs.
DCAs, yeah.
This is basically the structure where the broker, the person arranging the finance, was given discretion to actually set or influence the interest rate.
Ah, so they could push the rate up.
Precisely, allowing them to increase the consumer's cost of credit simply to increase their own commission. It's a clear inherent conflict of interest. Now, the FCA banned DCAs back in 2021, but these historic claims, well, they're now the core liability.
Okay, that makes sense. What's the second trigger? You said it relates more to the size of the payout.
That's right. It's what they're calling the high commission arrangement. The FCA has set a pretty definitive threshold here, based on their economic analysis.
Okay, what's the threshold?
The commission must be 35% or more of the total cost of credit and 10% or more of the total loan amount.
Right, so both conditions have to be met.
Yes, both. This threshold, it was statistically determined, essentially, to identify those cases where the commission had a disproportionately negative impact on the borrowing costs. Enough of an impact to justify the presumption that, well, the consumer really should have been made aware of it.
35% of the cost and 10% of the loan. Got it. And the third trigger, something about hiding licks.
Yes, structural concealment, basically, the concealment of a tied arrangement.
Tied arrangement.
Meaning the dealer, the car showroom, had an exclusive or some sort of contractual tie to the lender that wasn't properly disclosed to the customer. So those three things, DCAs, high commission, tied arrangements, they define the potential liability universe for your firm.
Okay. Now, when we talk about remediation, putting this right, the three proposed compensation methods sound incredibly complex. For senior manager listening, trying to, provision for this, what's the standard expected liability? What does the average payment actually look like?
Yeah, it does sound complex, but the key is to understand that these methods are primarily statistical tools. They're designed to ensure fairness across, potentially, millions of claims. The most severe one, the commission repayment remedy, this repayment of the full commission plus interest, that only applies in quite rare instances, cases that really closely mirror the original quite extreme facts of the Johnson case.
So, pretty rare then. What about the vast bulk of these potentially 14.2 million claims? What's the usual fix?
Well, the standard approach is going to be the hybrid remedy. Right. Now, this methodology, it averages the loss estimated through economic modeling and the commission that was actually paid.
Okay. an average.
Yeah, it's designed for speed and scale, really.
Yep.
And the FCA estimates the average redress, the average payout under the standard path, will be around £695 per agreement.
695 pounds.
That's your core provisioning target, probably.
Okay, and if those calculations somehow yield a really low result, is there a safety net, a minimum payout?
Exactly. The APR adjustment remedy acts as that floor. It guarantees the consumer compensation equivalent to a 17% reduction in their APR. So if the standard hybrid calculation results in a lower payout, the consumer gets the 17% adjusted redress instead. Ensures a minimum level of compensation.
Right. Now, here's something that sounds like a major strategic risk, something that should concern every senior manager listening: this presumption of liability. Given that some agreements date back to, 2007, firms simply won't have all the records, surely. How is the FCA dealing with these inevitable missing documents?
Ah, yes. This is probably the most crucial operational hurdle, I'd say. Where firms are missing records that demonstrate adequate disclosure was given, the scheme mandates that firms must presume disclosure was inadequate.
Must presume. Wow.
Yes, it immediately shifts the entire burden of proof onto the firm. It's a mechanism designed, to prevent consumers being disadvantaged by poor record keeping from years ago. But for firms, it basically means missing records equal automatic liability.
That significantly changes the complexity and the likely volume of the claims process, doesn't it?
That's
And
right.
we're already seeing the professional claims industry mobilizing, I gather.
Oh, the volume is astonishing. The Information Commissioner's Office, the ICO, they've already received over 230,000 spam complaints just through the reporting service since January 2025 alone.
Just since January.
Yes, all relating to unsolicited marketing for these motor finance claims. That figure, it really confirms that firms cannot just count on consumers filing complex claims themselves. The professional representative volume, the claims management companies, it's guaranteed to be extremely high.
And operationally, this volume just cascades down, I imagine. Brokers must be under immense pressure to dig out data for the lenders running the scheme.
Huge pressure. They have to comply with data requests from lenders, and they must respond within a 1-month deadline. It's a massive data scramble happening right now.
1 month, that's tight.
It is. So just to consolidate the timeline for everyone, the temporary pause on firms handling these complaints, that expires on December 4th, 2025. Firms must be ready by then.
December 4th. Okay.
And consumers, they have until July 31st, 2026 to refer their complaints to the Financial Ombudsman Service if they're not happy with the firm's response. And crucially, remember, the senior managers regime, SM&CR, is fully active here. Senior managers must attest to the robustness of their firm's scheme preparation. This carries real personal accountability for getting the execution right.
Personal accountability. Right. Okay, so having dealt with the enormous cost of past failures, let's look at where the regulator is actually quite aggressively fostering future engagement and arguably future risk. We saw a really significant policy reversal on October 8th regarding crypto assets.
That's right, big U-turn. The FCA lifted its 4-year ban on crypto asset exchange traded notes, or CETNs, for retail investors. This is, well, it's momentous, really.
ETNs. For those perhaps unfamiliar with the term, what exactly are they, and why does lifting this ban matter so much for the regulated sector?
Okay, so CETNs, they're essentially regulated debt instruments. They're issued by financial institutions, and they track the price of underlying crypto assets, like Bitcoin or Ethereum. By classifying them as transferable securities, the FCA has basically allowed them to be placed legally inside tax-efficient wrappers like ISAs, individual savings accounts, and SIPPs, self-invested personal pensions.
Wow, okay. That is a potential game changer, isn't it? It means UK retail investors can now get regulated, tax-free crypto exposure within their £20,000 annual ISA allowance.
Precisely. The previous ban, which kicked in when Bitcoin was trading around, $40,000, I think, it ultimately forced consumers who wanted exposure onto unregulated, often offshore platforms. This reversal brings that engagement back into regulated structures. It provides the oversight and, crucially, the tax efficiency that was previously missing. Some sources suggest this could project something like a 20% growth in the UK crypto market, pulling that engagement back on shore.
It's quite an aggressive move toward, regulated liberation, happening on the very same day, October 8th, that the Bank of England's Financial Policy Committee, the FPC, issued a pretty stern warning about the global tech landscape. It feels like the regulator is simultaneously penalizing past failures and embracing future high-risk assets.
It really captures that sort of impossible simultaneous position firms now face, doesn't it? The FPC warns specifically about the risk of a sharp correction for global markets, particularly if the The investor appetite driving artificial intelligence prospects were to suddenly reverse.
And that caution was echoed on the global stage, too, wasn't it?
Indeed. The IMF's Kristalina Georgieva issued a stark warning. She reportedly cautioned that AI valuations were, and this is a quote, heading toward levels we saw 25 years ago, drawing very clear parallels to the dot-com bubble era.
Dot-com parallels. Ouch. But this institutional caution from the FPC, it stands in quite direct contrast to the Bank of England governor's own enthusiasm for the very same technology.
It does. It's fascinating. Governor Andrew Bailey, in a separate recent speech, he really championed AI's role as the next general-purpose technology, or GPT. He actually compared its potential to revolutionize productivity and economic capacity to historic breakthroughs like, well, the steam engine and electricity.
Steam engine and electricity level.
Yeah. So you got the market stability guardians, the FPC, warning of a potential bubble, while the institutional head, the governor, is championing the revolution. Quite the split.
That tension, the huge promise of transformative productivity versus the risk of catastrophic valuation collapse, it's clearly driving broader economic anxiety. And we can see that anxiety reflected in asset performance globally, can't we?
Absolutely. We've observed a very clear flight to safety, or perhaps you could call it a flight to scarcity in non-sovereign assets. Gold, for instance, surpassed that remarkable psychological barrier of $4,000 per ounce.
$4,000.
Showing an annualized gain is over 50%. At the same time, Bitcoin, which seems to be confirming its safe haven status for many investors, hit an all-time high of $125,900.
And this surge, it's primarily linked to geopolitical turmoil and political uncertainty. Is that right?
Yes, largely. The ongoing conflicts in the Middle East and Ukraine continue to drive that safe haven demand. And it's compounded by domestic risk factors, like the prospect of a prolonged U.S. federal government shutdown, which markets hate. We also saw the sort of geopolitical benefit of this surge play out very clearly for sanctioned nations.
You mean Russia's long-term strategy of accumulating gold? That seems to be paying off.
Hugely. Their large gold stockpile, which they've been amassing since about 2006, is now valued at over $225 billion. That provides a significant economic buffer, helping to fund their ongoing efforts despite sanctions. It's a major vindication, you could argue, of their central bank's long-term strategy.
225 billion. Right, so that flight to safety is global, but back here in the UK, we're grappling with our own domestic instability. Notably, this projected 50 billion fiscal hole, which seems tied largely to a fundamental problem with economic forecasting itself.
Yes, the forecasting issue is key. According to David Miles, who's a leading economist at the OBR, the official fiscal watchdog, the core problem is productivity. He actually admitted that productivity forecasting has been, quote, catastrophically bad for a long period of time.
Catastrophically bad. That's strong language from the OBR.
It is. He highlighted that 15 years ago, economists expected the UK's GDP to be about 30% higher now than it currently is. That's a huge miss. And this deep uncertainty in our growth capacity, well, that's what drives the need for difficult fiscal choices, like the potential for deep public spending cuts we've been hearing about from Mel Stride, contrasting with the Chancellor's hints at tax rises. And you also have things like the French PM resigning, adding to European jitters.
Okay, let's try and wrap up by focusing on what feels like a tech paradox in UK financial services. This is where huge ambition and investment seem to run headlong into critical operational failure.
It's a real tension. The institutional commitment to technology expertise is, well, it's unquestionable now. Data confirms 52% of new bank directors now have deep tech backgrounds. That's up sharply from 36% not so long ago.
That's a big jump.
It is. And we saw JP Morgan Chase really solidify this ambition with a commitment to invest $350 million in its Bournemouth campus. They're aiming to create a, quote, world-class center for financial innovation, payments technology, and artificial intelligence.
$350 million in Bournemouth, that's a massive endorsement of the AI future they see. But almost poetically, in the very same week, we were reminded that the core banking infrastructure, the plumbing, can still be dangerously fragile.
That's the paradox of innovation right there. Metro Bank suffered a severe IT glitch on October 7th. It left customers with, quote, negative balances and missing funds.
Nightmare scenario for customers.
Absolutely. The human impact of that kind of operational risk was immediate and visceral. One distressed customer was quoted as saying they desperately needed funds for essentials like food and nappies. It just highlights that all the technological ambition in the world is pretty useless if the foundational stability isn't there.
Really brings it home. Okay, before we close, just a couple of final quick regulatory notes, perhaps?
Sure. In terms of enforcement, separate from motor finance, The FCA secured a pretty hefty 7.5-year prison sentence against a Daniel Pugh for running a 1.3 million Ponzi scheme. Just underscores that basic financial crime risks persist despite all the focus on big systemic regulation.
Still catching the fraudsters. Good.
And tying back perhaps to that issue of complexity and uncertainty, the government is proposing a major overhaul of the home buying and selling process here in the UK.
Oh, yes, I saw that. What's the plan?
Well, it involves mandating upfront information. Things like tenure details, flood risk, EPC ratings, title information, all required before a property is even listed. It's a direct regulatory effort, really, to try and reduce consumer uncertainty and those costly transaction fall-throughs that plague the market.
Trying to make house buying less painful. We'll see how that goes. And finally, for diary planning.
The next Bank of England Financial Policy Committee meeting is scheduled for December 2nd, 2025. One to watch.
December 2nd. Okay. So, wrapping all this up, what does this very concentrated week of news mean for you, the senior manager listening? It feels like there are 3 critical lessons from this deep dive.
I think that's right. Firstly, motor finance is a board-level crisis. It has to be. The potential $9.7 billion liability, the strict new rules, especially that presumption of liability for missing records. It demands immediate provisioning and robust SM&CR preparation if your firm has any exposure. No burying heads in the sand on this one.
Absolutely. Secondly, we really see the regulatory simultaneous position laid bare. The FCA is hitting firms hard for past misconduct with massive redress schemes, while at the very same time, it's liberating high-risk assets like CETNs into regulated tax wrappers. Firms just have to master this contradictory mandate, fix the past, innovate for the future simultaneously.
It's a tough balancing act. And finally, I think we have the tech perfect storm. You've got this huge AI ambition, massive investment flowing in, running directly into stark examples of critical operational fragility like the Metrobank IT failure. Managing the risk of that collision innovation meeting operational weakness, that's arguably the defining challenge for the modern financial system right now.
That really sums it up. And the ultimate theme, maybe, underlying both the economic anxiety driving gold and Bitcoin higher, and the regulatory liabilities piling up from disclosure failings, it just seems to be the sheer cost of complexity and uncertainty. The OBR admitted forecasting is catastrophically bad, and widespread complexity in consumer disclosure has somehow yielded this multi-billion-pound liability. Getting ahead of that complexity, whether it's in your forecasting or your internal processes, that has to be the highest priority.
Spot on. This has been Reg Talk UK for October 11th. If your firm writes motor finance, please share this with your board immediately. That consultation clock really is ticking.
Thanks for listening. Stay sharp and stay compliant.